Hello and welcome to the Property Trio, the podcast for the sophisticated buyer. Today we're unpacking a great listener question from Liam, and we're also appreciative of the timing of Liam's email to us. But first, before we get into that, I'm here with, as always, with my two co-hosts, Cate and Mike, who are ready and raring to go today. How are you both?
Good to see you, Dave. Oh,
Doing well.
That's good. How are you dealing with the budget shocks a couple weeks in?
You'd probably have a lot more fun with this podcast if we did a live recording at the pub. It's not been joyous in our sector for any of us, really, because we're navigating change and a lot of nervous buyers out there, and also it's not legislated, so we're anxiously awaiting, the final draft, I guess, and I'm not optimistic that we'll see some significant changes, but we need to factor those in before we make purchase decisions with our clients, that's for sure.
Yeah, we're certainly in a grey zone at the moment, aren't we? It certainly kept our minds ticking over, and
Yeah. You know what? It's a great time to buy for owner-occupiers. That's all I will say. I've had 2 weekends of some very, very good buying conditions.
Yeah. So, look, we did want to further unpack the budget announcements, but now we're a couple more weeks after the budget and we've had time to distill Labor's proposed changes. And we've been able to, dig deep, provide our own commentary and thoughts on the intended and unintended consequences. So beyond giving a lot of thought to the changes ourselves and providing our own commentary and insights, we've also observed the reaction within the property investor community and some thought-provoking articles that have been constructed by journalists, economists, and other industry professionals. So we thought our lovely listener, Liam, had some great questions that sort of sum up a lot of how people feel. And Liam is actually a young, would-be future property buyer and investor. So we thought we would incorporate Liam's questions into probably a bit of a deep dive into some of the big questions that are coming out of the budget. So without further ado, Liam writes to us and said, federal budget, wow, a big kick in the guts to those who want to get into property investment but are not quite ready to do so, like me. My question is, do you think there will be a period gap where you can nab a property for a lower value than it would have sold at? i.e., if an existing investor wants to sell before CGT changes next year, is there a period where a high supply will reduce prices? Also, can you unpack now what the perfect existing investment property looks like for someone who can't necessarily afford a lot of negative gearing, i.e. very manageable / negative gearing to start before turning neutral? So limited negative gearing. Is that too ideal of a property to achieve? ? So love those questions, Liam. We've certainly had a lot of commentary, questions, conversations on these sorts of topics. So let's jump into it, shall we? Cate, I'll start with you. Liam's reaction feels pretty raw, and it's a pretty good word to use. There's a lot of rawness out in the property and just in the general landscape. He said a kick in the guts. What are you hearing from your clients and people you're speaking with?
I think for the cohort that haven't yet had the opportunity to get involved in property investment, he summed it up really well. Kick in the guts is exactly how I suggest they're feeling. I've got staff that are in this position. I've got clients, more prospective clients I've been talking to for months. They're very much feeling a sense of being kicked in the guts because they've lost the opportunity that everyone before them has had. And with the grandfathering in place, it just feels particularly unfair. And, I wondered, when I first heard rumours about negative gearing changes, there was a little bit of word on the street that it might have been capped at 1 or 2 properties per person. And I think that would have been a lot more fair. For Liam's cohort, it's not just about having an investment property. There are a lot of buyers who have circled the idea of rent vesting because the area that ultimately want to buy a house in is cost prohibitive. And so the idea of spending a little bit less going into a really high performing region or capital city alternative to theirs, I'm talking specifically about Sydney siders, but that's not the only expensive city. They now don't have that option to build that wealth and to bolster up their deposit funds. And so, kicked in the guts is exactly what the younger cohort are all saying.
Yeah, 100% agree. I think the government underestimated people's sense of a loss of opportunity into the future. Anything you'd like to add to that, Mike?
Yeah, well, you talk about unintended consequences. Well, Liam is one, right? Because they're trying to fix housing affordability for first home buyers. And it's great if you are ready to go now. But if you're not, it's harder to get a deposit together. You can't invest in shares in the same way. The CGT impact hits you there. You can't rent vest in property and negatively gear it. So that pathway is kind of shut. And if, I know Treasury modelling very cleverly said only $2 extra a week in rental increase, but that's on top of what it's already growing. There's an undersupply of rental accommodation. This is likely to make that worse. So if you're not ready to go, you have to exist in an environment where you're renting, and there's a big fire under the backside of rents right now. So, kick in the guts, as Cate said, that just about solves it. And, in terms of unintended consequences, we can point to Liam, but he's not unique in this situation. There's a lot of people that will suffer because of this.
Yep. So do you think the budget has genuinely paused investor confidence long term, or is it more of an emotional reaction that will settle?
I think there's two things we need to separate. There's sentiment and there's mechanics, right? So sentiment moves instantly, and Cate's already said, great owner-occupier buying opportunities. The mechanics move a little bit more slowly, and of course we don't have the Treasury Laws exposure draft full documentation of what they're actually going to be debating in Parliament yet. But investors hear negative gearing, CGT changes, understandably feel like the rules of the game have changed overnight, but property markets don't reprice like the share market does. There's no big red
Not
sell
as quickly.
button. Not as quickly, no. No, it takes quite some time. And a lot of the time it's a bigger decision. Your share portfolio might not be as significant to you from a price point or an emotions point if we're talking about your principal place of residence. So I think the perceived impact is immediate because investors are all recalculating their risk. The actual market and whether those recalculations turn into widespread selling or weaker demand or a meaningful shift in borrowing decisions, that sort of takes some time as well. We haven't seen the exact policy. The government's already talking about a walk back. So there's a lot that needs to come out here to the point where we get, the actual structure of this. But in terms of sentiment, like we've seen before, like with COVID, like with interest rates, like with war in the round, people do jump at shadows. They overreact quite a lot. And, so many people, especially buyers agents, I notice at the moment are doing the whole, be greedy when others are fearful. And that's a line that's been around for a long time by one of the best investors the planet has ever seen. But very few people are actually willing to take that advice. It takes a lot of let's say, gentleman plums to make a decision in a tough environment.
Yeah, 100%. And you know what I would say about this? Mike's talked about property markets not moving as quickly. Well, yeah, it's not like the share market where it can, tumble in a day. But unlike the stock market that, can tumble in a day, when you introduce a legislative change or, even just a, first home buyer incentive, you can move markets very, very quickly. The market responds to that very, very quickly because it's, it's binary, it's black and white. At the moment, the binary change is that it's highly likely that most investors can't afford to negatively gear and can't afford the same borrowing capacity that they would have had. So, of course, that will shift a market overnight. And you have a line in the sand like the 12th of May at 7:30 p.m. Well, that change has occurred. That proposed legislation means that I'm going to auctions now and there are no investors. And it's a different run. And I'm not suggesting that it's that prices are dropping, but you've definitely got to look at market segments and work out the markets that were really investor heavy. We're seeing drop off there, absolutely.
Yeah, the thing with property, the shift that doesn't occur really quickly is people can't just hit a sell button on their computer and sell a property in a moment like they can with shares. So that runs over a longer period of time, much longer period of time. But what can happen pretty quickly is people can make the decision not to buy. And that's the big change that we're seeing right now with investors is, the vast majority of investors have hit pause.
Yes.
And
I had a
recalibrating.
perfect case in point last weekend. I was purchasing in Sunshine West for a lovely couple that have missed out quite a few times. And so, this was fourth time lucky. And with the investors out of the market, it was quite surprising because I've known that market for a long time, but sometimes you do get the buyers advocates all rocking up there, and that there's no joy in that when there's three of you fighting it out for a property. But we had three bidders, including us, and ordinarily you'd probably have a few more. It's a popular pocket. And the houses are really easy to value because the blocks are very similar. Most of them are on 697 square metres, and they're a cream brick, triple fronted brick and tile thing. It's a character that spans across Sunshine West. And so the going rate for an unrenovated one is circa 900, and for a renovated one is somewhere between 960 and $1 million. And I was looking at a mostly unrenovated one on a north-facing block, thinking it'll go for 900. That's 900 and something, and it went for 855. And it was interesting to look back at some of the other sales last weekend and the weekend prior. It was a distinct 5% off, which was really telling.
And I think that is an example of how a market can change in a situation like this. And look, I think this is the most extreme policy adjustment that I've been part of in sort of 25 years. Obviously, we lived through the GFC and through COVID, but they weren't necessarily major policy adjustments like this is. And, that drop-off in demand flows through that's a perfect illustration of how it happens, to flow through to individual properties. And particularly if it's in a market where there is a fair contingent of investors as well as owner-occupiers, versus if it's a market that tends to be only owner-occupiers.
Yeah.
Do you think the budget has genuinely paused investor confidence long term, or is it more of an emotional reaction that will settle over time?
Dave, not to interrupt you, but we've just answered that one.
Okay, help if I scrolled down. I wanted to remember the question while we're talking about it. Okay. Mike, from a data and policy perspective, what impact do you think these changes will have in terms of actual market impact versus perceived impact? We've just probably touched on it a little bit.
I suppose we did talk about that to some degree. I think sentiment moves things immediately. I think Cate has raised some good points about there being some structural changes. But again, this may not actually be legislated. It may be repealed in May 2028. We don't actually know. I think right now we're seeing knee-jerk reaction. We're seeing sentiment rather than sophisticated modelling of positions. I still think we've got to focus on the long-term fundamentals. We have a structural supply problem in Australia, and you could break that into listings. Listings just aren't there. I don't think this is an environment that's going to see a flood of listings, which was one of Liam's questions. Like, for example,
So that's actually that's the next question. So we can fold that into this question.
Yeah, I don't think we're going to see a flood of people wanting to sell their property pre-1st July next year, because they're just going to then cross over into the indexation method, which, depending on how you model it, what inflation environment you're in, how long you'll hold it for, it might not even be worse off, right? So I don't think we're going to see a flood of listings hit the market with those investors, although we do have a lot of ageing population. We've got a lot of boomers that are maybe kind of thinking, okay, well, this might be getting a little bit too hard, or I was going to sell anyway, especially in the markets that aren't Canberra, Sydney, Melbourne, right, where they've had a huge run the last couple of years. I mean, we saw quite a sell-off with the Queensland land tax legislation that came in, that was repealed actually hitting the date. But we saw a lot of people take money at the top. So, I mean, that's the possible thing that we might see with listings, but I don't think it's a race to do it before 1 July just for the 50% CGT exemption.
What have we experienced across past policy shifts? Do we actually see a surge in listings before changes like this take effect?
I think the way they've structured it made that hard, right, Kate? Like, so it was grandfathered to some degree. So if you're already negatively geared, it sort of locked those people in place, right? So there was no necessarily forced sale position. There might be some people that just kind of think it's getting a little bit too hard, but I think it was structured in a way that sort of made some sort of sense from a stability point of view. It doesn't mean I think it's a good policy, but at least the way that it was structured, that it created some certainty.
I think the big changer from the proposed policy point of view is the CGT as opposed to the negative gearing. I mean, negative gearing was absolute. After 7:30, that's it, it's gone. CGT, you've got a window of 13 and a half months to sell and get the 50% gain, or to face the new regime. So I think that we can anticipate seeing investor-led sales from older Australians who, are towards the end of their property journey and would have been dumping the money into super or shares anyway. And that will not shock me. And anecdotally, I've chatted to agents who have said that they've had, a lot of established house and inner ring properties and middle ring properties that they've been appraising for investors. So I think we can anticipate seeing a bit of a rush of stock in those markets. Unfortunately, the risk for tenants is that rental stock will be taken out of the rental pool completely, because they won't and can't sell to investors. They'll sell to owner-occupiers, whether they're first home buyers or upgraders, and we'll see some tenants getting displaced.
Yeah, but I think it could be offset by everyone who's had their property negative gearing grandfathered have no or very little incentive to sell. And then also with a flatter or potentially probably falling market, people will try not to sell unless they have to. So I think even if there is a certain percentage of potentially older Australians who decide to get out because their capital gains tax is going to be less than it would be after July 1, 2027, I think the offsetting effects will probably make, I think actually the net impact on supply will be still actually be negative. I don't think supply will overall increase.
No, I don't either.
There's the other driver of supply as well. I mean, I talked about listings and meant to sort of come back and talk about construction. There's some arguments to say that this could stimulate new builds, but the Treasury's own modelling are saying that it'll go backwards, right? And we no amount of stimulus can connect services, can speed up planning, can make the fundamentals in a high interest rate environment work for developers, right? We still can't build houses adequately to support the population that we've got. That's why I kind of think we need to focus long term on fundamentals. And we talk about it all the time. If you look at the property market over, say, a 30-year time horizon, and then you see big policy changes, elections, massive global events, you get this tiny little blip. And when you zoom out, it's not meaningful.
Yeah, I did a post on that actually in the last week, and saying, should we buy the dip, and looked at the last 40, 50 years of property movement and how, when the dips were and how briefly they went for. And that I suspect that's what's going to happen over the next 6 to 18 months. So, Kate, if Liam is thinking about waiting for a moment to buy when the market is theoretically at the bottom, is that a smart strategy or a risky one?
I think it's a risky one because property market volatility is at its sharpest when you have these shocks. And so timing the bottom of the market is a really intricate skill that I haven't seen anyone possess yet. I can look back and say, oh, that was awesome when I'm looking in the rearview mirror, but it was just by picking the day that I felt, or the weekend or the week that I felt was where conditions were at their worst. And, I know that sounds like a really crazy thing to say when I mention day or week, but if I cast my mind back to the onset of COVID, when the shock ripples went through and everyone started to panic, and then, pandemic was declared, and then we had to wear masks and, do the elbow bump and all that kind of stuff. Then there were talks about market drops and job security, etc. The market did go a bit into free fall. When I think about all of the downturns we've had, that was the fastest downturn I've ever seen. We lost more than 10% in like 2 weeks. And then it was like a hockey stick, and it bounced back very quickly. And I would argue that the very few clients that stayed with me and said, yeah, let's take advantage of this, they were very gutsy. They were the ones that did well, and I can point to the week that they did well. Could have I predicted it would happen that week? And after that, the following week would be, a market that started to take off? Not in a million years. So I think when you're trying to time the market, you've got to broadly look at it and think to yourself, yeah, it's advantageous. I can now buy into markets that I might have been precluded from. Let's just go now rather than wait to see if I could get, a further 5% or 10% gain, a gain on my own success, so a further discounting, or do I risk the market, bouncing back with a change in policy or something that triggers all of the buyers coming back, or renewed confidence? I think it's dangerous to hold out for the very, very, very bottom. I think when it's really obvious that you're in tough times and that you're in the advantageous position, that's probably the time to get serious about nailing the right property for you, and not trying to look in the rearview mirror too much about, how many more thousands you could have pulled off your purchase price if you'd waited.
Yeah, and I think as we've talked about a lot, and you've mentioned a fair bit over the journey, market lag, which is what the average punter is seeing in terms of the data, it's coming out a month or 2 months later in the numbers. So by the time, the numbers have changed up, let's say they're starting to move up again, or sentiment's starting to move up again, well, that's happened on the ground a month or 2 months earlier, because, literally, as you say, as sentiment changes, that can be over a weekend or a week or two. But you only know that if you're really out there day in, day out on the weekend, and you see there's that sense of a change in sentiment. And once there's a change in sentiment, and I think we've probably had that happen in a lot of Australia right now, prices probably in a lot of places have fallen by 5%. Like that example you've already provided this morning. But what we've also got to remember is every single property is different and unique. And it comes down to the 2, 3, 4, 5 people who actually want to buy that individual property as to what is the outcome for that property. And that's what our listeners must always remember. Yeah.
And, we talk about unique properties and unique market conditions. You've got unique buyers as well. I was on a negotiation yesterday. We got the upper hand because the vendor needed a very specific settlement date. So another buyer had a bigger budget than us, but they couldn't make that settlement date work. Could have I had that negotiation span out over another day, they might have sorted their finance situation out, managed a different settlement. They could have introduced another buyer. You've got to make that decision, to jump now when it's the right property at a price that you're happy with.
Yeah, there are all different sort of factors that go into a negotiation, a purchase. I mean, I recently negotiated a purchase for my parents, and one of the things they had the advantage of doing, and I know this played a part in the outcome because there was a number of buyers at around the same point, they were able to settle in 14 days and pay with cash. So, that was helpful to the negotiation.
100%. Yeah.
So, Cate, Liam's second question is a great one. What does a perfect investment look like now, in your view, if you can't afford heavy negative gearing?
Yeah, I'm sad about this one because we're now having to think laterally about how to tackle this when your borrowing capacity is likely reduced on an established property. Your rental yield is probably looking attractive. I mean, rents have been climbing, and Liam doesn't have other investments that are positively geared for me to offset his losses against. So I've got to think, really strategically about this. Does Liam look at buying a new property in a quality area in a more boutique block? It's not really my preference. I still think long term, we have to pay attention to land to asset ratio and all of the other growth drivers associated with locations. But if Liam wants a house that's established and he's got less to spend and he's a bit more reliant on the rent, I don't think he can overlook the regions. We still have some very attractive options in the regions for those who can sustain a little bit of negative cash flow. And so the long range view of this is, how long will it take to be cash flow neutral? You'll get generally a shorter tenure of cash flow negative on a regional property because they do tend to turn cash flow positive a bit quicker. And Liam might also be in a position to allocate a little bit more capital to the deposit so that he's less negative cash flow. He might also be able to do some upgrades, updates, cosmetic work to get a little bit more rent. So you definitely have to think laterally. But if established won't work for you, you do have to have a conversation with someone who knows what they're talking about and is independent about where you could target newer builds or new builds.
Yeah, and I think it's becoming even more important for property buyers and investors to know precisely the cash flow outcomes from their purchase, because every dollar of negative cash flow obviously is impacting. And look, it's always been the case, but people probably have been more blasé. But now they need to understand they won't be getting a tax deduction against that negative cash flow. So you just need to know what that number is. How far is your cash flow going to go backwards? In essence, that hasn't really changed. People are just going to become more aware of this. Like, for example, if your property was $1,000 a month negative cash flow, and let's say you got, $300 of that back in tax based on your tax bracket, where your only true cash flow was negative $700. Well, now it's going to be negative $1,000. So, people might actually just better sharpen their focus on knowing exactly what their negative cash flow is going to be. I mean, it sounds so obvious, but most people rely on serviceability calculators and borrowing capacity, and they do not actually know what their cash flow is going to be when you factor in all the inputs and outputs, which starts with your own net income and living expenses. And then the actual easy part is the property calculation. But also people should remember that you're still able to claim these losses down the track once your property is positively geared. You just need to make sure you can hold it for that period of time. Or if you do sell it, you want to have a capital gain because you can offset the losses against a capital gain. So high level, in theory, nothing's really changed as long as you can hold it to make a profit to offset your losses.
Yeah, we can still claim those deductions, but we're just claiming them in the least beneficial way for a property investor. Like, it's so much more beneficial to have them immediately to follow that, to stomach that shortfall. It's nowhere near
because a dollar today, $1 today is worth much more than $1 5 years down the track or 8 years down the track because of inflation. Yeah. But we still get the claim losses.
The disadvantage, so the thing that has changed and will change is the borrowing capacity.
Yeah, yeah. But look, everything's when changes occur, there are recalibration and a new normal begins. And so right now we're going through a recalibration, whatever that ends up looking like. And we're not sure on what the tax outcomes are going to be legislated. But the likely outcomes, we know borrowing capacity is going to reduce for a period. And then that becomes a new normal. Okay, but borrowing capacities are always changing. That's the reality. Because rates go up and down, so borrowing capacities change. So
Policies
change. What's going to happen, I think, is yields are going to rise to offset the reduced capital growth. So your net return's actually going to be give or take the same. I think that's what's going to play out. And we're going to get back to more where yields were at like 30 years ago.
Yeah.
30 plus years ago.
Right. And the analysts are certainly talking about that. I mean, Pete Wargent was talking about the change that we'll see in the returns mix with it, skewing towards rental yield, and how quickly that will happen will be really interesting to see.
Yeah, I think it's going to happen in the next 6 to 12 months.
Yeah.
Mike, there's commentary suggesting this could mark a structural shift in how property investment works in Australia, not just a cyclical change. Do you see this as a temporary adjustment or the beginning of a very different investment landscape, which I suppose is sort of what I've just been talking about?
Yeah, just a couple of points on that. I mean, if it gets legislated, I think it will be a structural change for investors. The old model was to buy an established asset, tolerate the shortfall and let the tax system soften the pain while you wait for the capital growth. That model becomes a lot harder now. Investors now need to be more numerate. As you said, they need to know the cash flow. They need to understand it before tax, after tax, depreciation, land tax, insurance, interest rate risks, vacancy risks, yield calculations, and what's happening to the broader rental market. But I think changing investor incentives is not the same thing as fixing housing supply. If we still can't get enough homes approved, financed, built and delivered, like I've been saying, I think ever since that policy was announced nearly about 3 years ago, then we're still going to have that underlying shortage. The government is trying to push capital towards new supply, of course, which on paper sounds really good. But the open question is whether the construction sector can actually deliver enough new supply for that policy intention to actually become reality. And it's like, where is that supply as well, right? I've spoken to a lot of people that are now targeting like the infill stuff, but a lot of this supply is not necessarily in places where people want to live. Like they're often quite a distance from capital cities, from the employment hubs, from where people want to be and work. I don't think this is going to be the panacea that the government expects it to be.
Yeah.
And in all honesty,
100% agree.
They believe it.
Well, I
Thanks,
think
Dave.
they're dealing with a wave of feedback that it will make them certainly, and it appears they are, some of them are second guessing or re-evaluating how they thought about some of the taxation changes they've put in place. It does feel like that.
Chalmers said in an interview that it went right down to the wire. Only about 3 weeks out from the budget speech did they decide to go after the whole gamut. Now, I don't know whether they were talking about CGT or negative gearing individually or together, but I think the consultation has been very poor. Cate mentioned something that actually is now the official policy of One Nation, which is interesting because it was sensible. And that's that they're basically saying we support limiting negative gearing to 2 properties for all investors and completely opposing the CGT changes. And that would have been much more of a middle ground, and it would have supported those pathways like rent vesting for investors or investing your deposit. And the Treasurer recently said, look, according to, I think it might have been Treasury, that only 1 in 15 first home buyers invest in shares. And then there was a journalist saying, well, ASIC said it's 1 in 5. He's like, I'll I'll have to check those numbers. I'm thinking, gosh, for this sort of fundamental taxation shift, you kind of want to be across those numbers. And I think our finance minister has been making memes about her financial acumen lately as well.
Yeah, I'm pretty sure I'm on record a few times on this podcast saying, like in the early days on episodes with Cate and Pete, and saying, look, I think there will be some reform with negative gearing, and whether it'll be 2 years down the track, 5 years down the tracks, I just thought the jungle drums were beating, and just there's enough negative sentiment about property price growth. I felt like it was going to happen sometime down the track. One of the things I have spoken about and even put back in our property plans as a risk for our clients as far back as probably 7 to 10 years is negative gearing being brought, taken away. But I have thought potentially it would be limited to the number of properties you would be able to negatively gear. I do understand the risks in that space as well. And there's the argument that the wealthy, can buy, $2 million properties if it was limited to 3 properties, whereas, others may not be able to invest that amount and get the same negative gearing benefits. And there are some other complexities around that. But I think some sort of approach where you could still negatively gear, but it's just a limited number of properties, that there's certainly something in that.
Or a limited amount of gearing.
Yeah, limited dollar value.
If you're wanting to, give a young first-time investor a chance, well, they're not going to go out and buy a $3 million asset and gear $60,000 worth of losses a year. But if the cap is $20,000 worth of losses, well, that might give them an opportunity to buy a house in a gentrifying suburb that will give them the opportunity to build up their savings and their deposit.
I think one of the big questions out there in the ether, because obviously established property as a general rule from a capital growth perspective has outperformed new property by a reasonable margin over a long period of time, is without the gearing benefits, or the delayed gearing benefits, is established property still going to, as a general rule, trump new property? That's like a big sort of up in the air question to a fair degree. I've got my views on that, but what are both of your thoughts?
I think we're going to see an immediate flood of investors hitting new stock. And I use the word artificially driving. If the market's being driven, it's being driven. But I think we'll see it being driven by investors as opposed to owner-occupiers. And what we also mentioned last week was the surprising number as a percentage of first home buyers who buy new. They'll be competing in that space as well. And first home buyers buy new stock for all kinds of reasons. Often it's because they get incentives, or they can purchase for a much lower deposit. Sometimes you can get in on and off the plan with $1,000 deposit. And other times
they can
just
build a bigger home on cheaper land.
Yeah. There's a raft of reasons why first home buyers have gravitated to that space. And what was surprising for me was it was more than 50%. So nationally, the figure is, I think it's 53. And some states and territories were closer to 60, and I think 2 were 47 and 49%. So we're talking about just a little bit more than half of the purchase decisions that first home buyers make is to buy new. Well, now they're competing with investors. So I do think in the short term, we could see established property reduce in value, but we've also got some headwinds around locations. And first home buyers will look at, if they're considering an apartment, they will weigh up an older style boutique apartment with an owner's corporation fee of $2,000 a year against the shiny new thing with an OC fee of $5,000 a year. And they're not silly. They know how to ask those questions. They understand that strata fees are expensive, and they do tend to vote with their feet. So I think that the rattles that we'll see across our markets, particularly in the established space, won't be long-term changes. And I also think that once the investors who are selling in this 13-month window have sold their houses, we're going to see a lot of homeowners who own houses sitting tight, because there'll be that chicken and egg issue. They'll be wondering, where do we upgrade to if there's not a lot of stock? And we'll also see a lot of people choosing to store their wealth in their family home. So long term, I'm not nervous about established property in good locations. And I think the inner ring and middle ring, from an amenity point of view, they're very desirable.
Yeah, I actually think quality established property is going to get even harder to buy, because not only are owner-occupiers going to hold for longer, the storage of wealth in the family home, which already was a key benefit because of the being tax-free, but all the grandfathered negative gearing benefits are going to provide further incentive for people to hold their investments. I think we're going to have a greater dearth of stock of established properties in the best locations, in the best streets around the country. And we've already seen the amount of time that people hold properties for on average blow out over the last decade. And I think that's going to actually exacerbate that problem. And so, it's actually the supply issue is going to get worse, but that's going to reinforce the growth prospects of those properties. Plus, we are going to see yields increase significantly. Like, I think people are going to be surprised by how much yields are going to increase, and part of that will be a bit of a price reduction initially, until
increase.
Until that, with the rents flying, prices falling a bit, yields are naturally going to just rise. I think they're going to rise pretty quickly, and all of a sudden there's going to be this real case for residential property again, just purely from the yield perspective.
I'm thinking back to the beginning of the calendar year where we made our property market predictions for 2026. That's going to be an absolute massacre when we revisit those.
Yeah.
Everything is new.
Yeah, because Albo kept saying, I'm not saying it again. Negative gearing is off the table. He was pretty emphatic that he wasn't tinkering with those policies. And, we made our predictions on the back of a lot of that.
Yes, and to your point, Dave, I think if new property transacted the same way established property does, I would say it would probably outperform in the next little while. And what I mean by that is that when you have a new property coming to market, there needs to be developer profits. There needs to be margins from the builder. There's statutory charges that equate to nearly half of the cost of the whole bloody thing, right? You've got channel agents, you've got an army of spruikers out there that are forcing people in that direction. And one of my favourite economics books or behavioural economics is Freakonomics, and there's a couple of those. And you could summarise the whole thing by saying, show me the incentives and I'll show you the behaviour. So the incentive is to buy new, and I don't believe it to be because of an educated decision, but I do agree with Kate that we will see a flood of investors going to new stock. And back to your point, and this was one of Liam's questions, do we think there'll be a flood of people selling up until 1st of July 2027 to lock in that CGT? Well, no, because from that date on, it just moves to an indexation model. So it's not like fundamentally, all of their profits are going to be taxed in a different way. It's only really from that date onwards. And I do agree that if these people if they were going to sell in the next 2 or 3 years anyway, they might do it now. But if that time horizon is 5 or 10 years down the track, they've got this golden goose, this grandfathered asset that can be negatively geared in perpetuity. Why would you want to get rid of that? Another economic concept is loss aversion. If we see a decline in the market, people do not want to sell a property from less than what they paid it for. So there's a lot of people that may have purchased in the last little while that aren't necessarily sitting on a big amount of growth, or after they work out the CGT, they're like, it's not really worth it. We'll just ride it and see what happens, right? But another bigger thing that I think a lot of people maybe aren't talking about is that this 5% deposit scheme that the government brought in for first home buyers. We talked about that a few episodes ago, where basically every market under that cap has moved disproportionately to other
Probably
price
by
segments.
more than 5%.
Yeah. So if we see some sort of downturn, which I don't believe it will be a huge downturn, but we could have a whole host of first home buyers sitting in negative equity positions or thereabouts in an environment with increasing interest rates. I've already heard some whispers of mortgage arrears rates moving. Now, that's not a budget story. That's a cost of living, war in Iran, interest rate story. And, you know, I would be concerned if I was the Labor government with encouraging all of these first home buyers in with these 5% deposits and then hitting the market with a sledgehammer and then expecting them to carry the can.
It's a great point. It's one I've thought about as well, Mike, in terms of I think we're going to have a whole bunch of first home buyers who've got in with this boost who are going to go into negative equity. And I did mention, I read something in the last 2 to 3 weeks, how the arrears on these first home buyers who have used the boost is rising. And it's higher than obviously other segments. And first home buyers tend to be higher anyway. But the ones using the boost are higher and rising. I think, I agree. I think that's a story that's going to play out. I think it's going to become a little bit of a car crash for the government over the next 12 months. As more and more of these first home buyers who got in without hardly any savings go into negative equity, and then there'll be stories of some of them selling and not being able to sell what they purchased for. And we know what the media will do. They'll go, government gave first home buyers too much money to buy a house when they shouldn't have been buying it, and the prices are rising. Then government changed tax laws, prices drop, and all these first home buyers are losing. That, and you don't need a lot of them to write a story, and you just need one example of it.
It'd be a massacre.
Yeah,
absolute. It'd be an absolute massacre, and I think they will do whatever they can to avoid that. And I think we're going to have a busy couple of weeks in politics with how things potentially get adjusted or wound back.
Dave, can I qualify, because that data would be so interesting to get my hands on? Are the increasing numbers of arrears in relation to boosts, which are gifted from the government when they're purchasing new, or is it the 5% deposit guarantee recipients?
The 5% government guarantee recipients, I'm pretty sure.
Yeah, interesting.
Yeah, but Google it. It was a few weeks ago. Yep. But yeah, there was a first home buyer cohort who's been receiving some sort of benefit, but I think it was the 5%. Those who are getting the 5% benefit.
Excellent.
Yeah. Look, I also, there's definitely going to be bees to the honeypot with regards to buying new, and that's going to play out over the next year, maybe beyond that. But it's going to push up prices. One of the things I've learned over the 20 plus years and meeting hundreds of people who unfortunately bought off the planned property and then found out they'd bought a dud is it's a really slow moving car crash or train crash or whatever the saying is. People often don't get these realizations for years down the track. And that's going to be the high risk again. But I think what will happen probably with the new properties is there'll be a jump and then there'll be a plateau. And so there'll be a lot of people who get in initially and then pay over the odds, but they won't realise the mistake they've made until further down the track. And unfortunately, with what I think is going to happen with established property is it's just going to mean the wealthier investors and the more educated investors are going to still keep buying the established property. And one of the reasons is because of the policy changes, they're going to be more able and willing to hold long term and wear those cash flow losses without getting a tax deduction off them.
And who knows how long they have to wait before those things actually become positively geared anyway, if we see rents doing 10% year on year growth like they sort of have been.
Yeah,
Well, if they're
I
wealthy
think
investors or if they've already got a portfolio, they probably already have some properties that are delivering cash flow positive
Yep.
outcomes. So there will be deductible expenses and operating losses there for them to claim. So they can effectively negatively gear.
but only their existing properties,
Yeah,
because you've got to wait for the positive cash flow on
right.
that particular property. Okay, final question for you both. Economists are saying this budget could dent investor sentiment in the short term, but not necessarily change the underlying supply-demand imbalance. Do you both agree, or do you think sentiment alone can move prices more than the fundamentals right now?
Oh, I think there's two parts to that statement that are wrong. First and foremost, I think we will see rental supply decline and be depleted, and that's a massive risk. I mean, they've focused on first home buyers, but the housing affordability crisis is not just about young people getting on the property ladder. It's about renters being able to have an affordable roof over their head. You know, the idea of tent city doesn't appeal to any government. And then the second part to the question, does sentiment alone change it? No, it doesn't. I mean, Mike said at the start of the show that sentiment can play a huge part, while the dust is still settling. And like all changes, we will all adjust. But there are structural changes in this budget new regime. And I think the risks associated with displacing tenants and forcing rents up is probably far greater than the issue that they thought they were dealing with, which was first home buyer opportunity.
I would firstly say don't put too much credence into what economists say. They had a really good go of a similar market shock with COVID and made an absolute meal of it. But I think sentiment absolutely matters. It can delay buyers and bring forward sellers and change auction energy, as Kate's already seen. But sentiment usually has its strongest effect at the margin. The fundamentals will decide the longer game. Like if population, household formation, rental demand remains strong and we still don't build enough homes, then the underlying pressure doesn't disappear because investors are annoyed. The budget can change who wants to buy, but what to buy and how they run the numbers. Like that's the key stuff. So unless it changes how many homes we actually produce, it doesn't magically solve that shortage. So I suppose, like in that point, whilst I said be wary of what economists are saying, I agree in principle. Short-term sentiment can absolutely move prices in pockets, but the deeper question is whether this policy actually improves the supply. That's the intention, and that's the part that I'm really not convinced about. And again, like we say so often, there's markets within markets. There is no property market. It will be lumpy. We will see some areas be resilient. We will see some areas suffer, and that'll be the interesting stuff for us to unpack over the next 6 months.
Yeah, and maybe over the next 12 months and 2 years until the next election, perhaps. Yeah. All right, look, I think we could talk for another hour on the fallout, the implications, what we think might happen, but we have to end the podcast at some point in time. So let's jump into our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
It's a very difficult landscape for investors to navigate right now because we've got proposed changes and there's always that debate. Do you jump in quickly before the herd or do you wait for policy clarity? But I think when it comes to negative gearing and capital gains tax changes and trust changes for that matter, we know that they are reworking some of the policies, and I think it pays to be prepared to move as soon as we've got clarity, and that means being pre-approved and understanding the cash flow ramifications of either scenario. I would be tempted to wait it out to see what changes transpire.
I said on budget night, the best time to buy property was yesterday, but it was even better yesterday when we were talking about on budget night. But I still think that sentiment holds true. we know the situation now. Sentiment can't really get any worse. The Labor government's not going to sort of say, well, now we're increasing the capital gains tax even more, or now we're actually saying if you invest in residential property, you'll go to jail. I mean, like, I wouldn't put it past them. It does sort of seem a bit out there already. But, like, there's never going to be a better opportunity now, I think, sentiment-wise. I'm not saying that this is a strategy that anyone should take, is like wait for sentiment to go in the toilet and then dive in. But if your plan was to purchase property, then you continue with the plan, right? Waiting 24 months to see what happens and what settles, like, you might actually find that this legislation is repealed in May 2028 if the Liberals win the election, and you would have been very, very grateful to buy within that 2-year window. I just think you've got to be smart, you've got to be clever, you've got to understand the cash flow. I think that's the big one, and you highlighted that as well, Dave. Like, if your plan was to purchase property, I say stick with it, but be very, very careful to understand and model the cash flow. You don't want to be into a situation where you're forced to sell and abandon that strategy just because you didn't model it properly.
Yeah, look, that's a great gold nugget. I just pretty much say ditto to Mike's gold nugget. And understand your buffers. What's your surplus cash flow you want to have after you settle on the property? What's the savings buffer you need to have to feel comfortable if you had a challenging period? What are your LVRs that you want to land on? And that determines your price point. And Mike makes a great point. It's like they're almost certainly not going to make the tax changes any worse. If they do end up legislating and moving things, it'll be making them slightly better. So in all likelihood, and my gut instinct is that this is going to prove to be the best time to buy, and let's just say the markets even fall a bit further between like buying today and, when it starts to sort of settle down, maybe in 3 months, 6 months, 9 months. It's unlikely to move very much at all. But what I suspect is going to happen over that next 12 months is your rental returns are going to increase in terms of the actual amount people have to pay, because there's going to be less supply of property, and yields are going to keep rising. And I feel like people who buy over the next year are going to actually, if they look at their yield relative to the price they paid for the property, I think in a very short period of time, they're going to be looking at 5, 6, 7% yields relative to the price they paid for the property. I think that's part of what's going to happen over these next couple of years.
I was going to say, to quote Lord of the Rings, like, let this be the day where we draw swords together. I think Treasury have absolutely biffed this, and I'll charge into battle with you to argue for Speaker 1, 2, 3, however many we need, to the negative, that it's going to rise by $2 a week.
Yeah. Well, look, what I'll say is, taking a national view, they've said that property values may grow 2% less per annum than they would have otherwise. And let's say that's
2%, $2. I think they're just using the same
number two. But I think yields will rise to 2% to offset, so the net return is going to be basically the same from property. But let's just look at that from an asset perspective across the country. Today's residential property is worth $12.3 trillion. If properties grow at 6% over the next 30 years, the residential property asset value of Australians will be $70 trillion. If they grow at 4%, so 2% less, like Treasury predict, our residential property value, which is really the store of Australians' wealth, is $40 trillion. So do we really want our country's wealth to be like the power of compound, $30 trillion less in 30 years? And because of the power of compound, just 2%, our asset value of our main storage of wealth will almost be half what it otherwise would have been. They've modelled because of these tax changes. Like, can anyone seriously argue that would not put a dent in our living standards, business investment, and long-term economic growth?
I don't think they're thinking about the future, Dave, because if they were, they'd be scratching their head and wondering how they're going to support the elderly with, we've got superannuation in place for good reason, and there are so many moves here that are going to reduce younger Australians' ability to provision for their future.
Yeah.
This is not a future-thinking budget change. I think it's an election winner and a vote grab.
They thought it would be, but I don't think it's going to be. And it actually positively impacts such a small percentage of the population. Was it 7,600 buyers per annum they've estimated? That'll help.
Yep.
76 divided by 10 or something like that. Yeah.
Yep.
Tiny. Anyway, I'm going to do a post on that as well soon. All right.
Well, thanks, Liam. That was a belter.
Yeah.
Thank you, Liam. I hope that we've answered some of your questions, and cast your gaze to regional markets if you've got the capacity and interest to do a bit of online research.
All right. Thanks very much, Mike and Kate, and look forward to seeing everyone and chatting with you too next week.
See you next week.
See you then.